The K-shaped economy. The rich keep getting richer, and everyone else is getting left behind. But there is a way off the bottom branch. Let me show you how the K got so wide. Since 1989, the top 10% of Americans have seen their share of national wealth grow from 32% to 68%. Meanwhile, the bottom 50% owns just 2.6% of the country's total wealth. The pandemic made it worse. The top 1% added over $6 trillion in net worth. The bottom 50% lost ground. The wealthy own the assets that go up. They're insulated from the costs that rise fastest. And the system keeps reinforcing itself. The $10,000 question. 60% of Americans under 30 have never owned a single stock. Not one. And here's why that matters. The S&P 500 has returned an average of about 10% per year since 1928, with dividends reinvested. A $10,000 one-time investment in 1990 would be worth over $300,000 today. That's not luck. That's compound interest. Vanguard, BlackRock, and JP Morgan all forecast 5 to 7% annual returns over the next decade. Even at 6% instead of 10%, compound interest still works. It just needs more time. The worst thing you can do is not start at all. The generational wealth gap. The average 401k balance by generation tells a stark story. Gen Z averages $18,000. Millennials average $82,600. Gen X averages $215,600. And boomers? Over $286,000 in their IRAs. But here's the thing. A Gen Z investor who starts at 22 with $8,000 and adds $500 a month until 65 at 7% ends up with over $1.7 million. The math doesn't care about your generation. It only cares about when you start. The 3 barriers. Most people never invest because of 3 things. Fear. The market dropped 34% in 2020. If you stayed invested, you recovered in 18 months. If you sold, you locked in your losses. Jargon. The financial industry invented confusing language to make investing feel exclusive. It's not. Investing is simple. Buy broad, hold long, don't touch. And the minimum myth. You don't need thousands. Fractional shares let you buy the S&P 500 for $5. Fidelity, Schwab, Vanguard. 0 commissions. The simple strategy. Step 1. Open a brokerage account. Fidelity, Schwab, or Vanguard. 10 minutes. Step 2. Buy an S&P 500 index fund. VO, SPY, or IVV. Step 3. Set up automatic investments. $50 a week. $200 a month. Automate it so you never think about it. Step 4. Don't touch it for 30 years. As Warren Buffett said, the people who win in the stock market are the ones who do nothing at the right time. The cost of waiting. If you start investing $200 a month at age 25, you'll have about $525,000 by 65 at 7% returns. If you wait until 35 to start the same $200 a month, you'll have about $245,000. That 10-year delay costs you $280,000. The single biggest factor in building wealth is not how much you invest. It's how early you start. So here's what you need to remember. You don't need to be rich to start investing. You don't need to understand the stock market. You don't need to time it perfectly. You just need to start. Open an account. Buy an index fund. Automate your contributions. And wait. That's it. That's the whole secret. If you found this valuable, subscribe for more personal finance content every week. And drop a comment. What's the one thing holding you back from investing right now?